Hello, I'm Cyril Vanier. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, the U.S. Federal Reserve cuts interest rates as the job market slows. The central bank is under pressure from Donald Trump. Will cheaper credit save American jobs, or could it fuel inflation? Bigger, smarter, faster. Chinese electric vehicles are racing ahead of their global rivals. European car makers are trying to catch up. Can they challenge Beijing's hold on the road? Uncovering Senegal's hidden debt worth billions of dollars. The government wants to raise taxes and cut spending to tackle its borrowing crisis. But who ends up paying the price? So the U.S. Federal Reserve is walking a tightrope. It wants to keep employment high and inflation low, but both are pointing in the wrong direction. For now, policymakers seem more worried about the health of the labor market than the risk of rising prices. So, for the first time since December, the U.S. central bank has lowered interest rates to help shore up the ailing job market. But that might also push up prices. Also, the Fed faces political pressure, with President Donald Trump accused of challenging its independence. Chairman Jerome Powell has resisted Trump's calls for bigger rate cuts, but weakening economic data has now forced his hand. Here's how it all works. The stability of the U.S. economy widely depends on the Fed because it sets national interest rates. When the labor market is weak, cutting interest rates can make borrowing costs cheaper for businesses and consumers, and that can prompt companies to hire more and fuel the economy. When things are flipped and consumer prices are high, the central bank can raise interest rates to cool the economy and ease inflation. At the moment, the numbers point to a significant slowdown in the economy. Employers across the U.S. added just 22,000 jobs in August. That is considerably less than the 80,000 new jobs economists thought would be added that month. Layoffs are rising as well. Weekly unemployment claims reached the highest level since October 2021. Many employers say that they are freezing new hires, waiting to see how Trump's new policies will affect their bottom line. Tariffs, firing public workers, and a crackdown on immigrant labor. All of this is posing a dilemma for the Fed in the context that we explained, where hiring has slowed sharply and inflation remains high. Another concern is the Fed's independence. We touched on it. For decades, it's been a nonpartisan pillar of America's economy, unaffected by politics, in other words. But Trump is openly exerting pressure and threatening to replace board members with political allies. Recently, he tried to remove Federal Reserve Governor Lisa Cook, a move which, by the way, has just been blocked by an appeals court. As for the Fed chair himself, Jerome Powell, who has drawn the president's ire for not lowering interest rates earlier and deeper, he insisted that he would only do so when the economic data showed that it was the right move.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings.
So Howard Reed is an economist and the founder of Landman Economics. He joins us from Colchester in the UK. Howard, thank you very much for your time. It's great to have you on the program. So we just heard the Fed chair, Jerome Powell, announce, as had been widely expected, that he was cutting interest rates by 1/4 percentage point. What will this mean for American consumers?
Well, 1/4 point's not a huge reduction, but it should help the labour market a little bit. I mean, the graph that you showed earlier showed that hiring activity by US employers has essentially kind of fallen off a cliff since April. The last 4 months have been historically pretty bad in terms of number of jobs added. So that should help the labour market a bit. It may put upward pressure on prices a little bit, but as I say, it's only 1/4 point. So I don't expect much to happen in terms of increased consumer prices because of that reduction.
So in that case, if you don't expect much of a change, why didn't they cut the interest rates further?
Well, that's a very good question, and if I'd been the Fed chair, I would have argued for that. I think the risk from a slowing labour market, due to increased uncertainty, businesses are worried about hiring because of the Trump policies, the tariffs, the big public sector layoffs, and so on. I think the risk to the labour market from that, the downside risk to the labour market, is bigger or outweighs the kind of upward risk to prices from cutting rates, partly because a lot of the impact of prices is things like the tariffs, which are a one-off, presumably a one-off. So as a one-off upward shock, it's not going to be repeated. At least we hope it's not.
We'll talk about the Fed's competing goals in just a moment. But before I get to that, how long does it take for a rate cut to actually be felt by consumers? Are we talking days, weeks, or months?
I would say it normally takes a few months to feed through, really, particularly small rate cuts like this. If you've got a really big shock like the 2008 financial crash where central banks kind of cut rates very quickly, then you might get a faster feed through. But I would say it's not the sort of thing that you're going to feel the effects of next week, but probably a few months is more likely, because it takes time to feed through to businesses' hiring and pricing decisions.
So the Fed has two goals, and we've touched on it, and its maximum employment is one goal, and you've just done a great job of explaining that their rate cut is in order to help the jobs data, right? Help hiring, ultimately. And the second goal of the Fed is to contain inflation. They actually have a target, it's 2%. The reason I bring this up is that U.S. inflation is currently above target. It was measured at 2.9% in August, year on year. That's the last number that we have. So the target is 2. The real number is 2.9. So why is the Fed taking measures, cutting these rates, that will not help this other goal of containing and reducing inflation?
That's a really good question. I mean, the thing is that there are two separate objectives. And for now, the Fed has decided, I think rightly, that the objective of supporting the labour market and, helping businesses to increase hiring and reduce unemployment, that kind of outweighs any short-term risk from higher than anticipated inflation. I think the one-off shock from the tariffs, plus some other things that have been going on, like increased food prices due to disruption caused by climate change. There's a lot of shocks going on at the moment, and the Fed's probably made the judgment that core inflation in the medium term, into 2026 and beyond, is going to be lower than 2%. So a lot of these one-off shocks are kind of pushing up the rate to 2.9%, but that doesn't reflect the more medium-term outlook for inflation. So it's kind of safer to cut rates than it would otherwise have been.
The Fed's interest rates with this new cut are between 4 and 4.25%. That is not at all what the president of the United States wants. Donald Trump wants a much more aggressive rate cut. He has said in the past he wants to see interest rates at as low as 1%, right? From 4 where it is now to 1%. That's a big change. What difference would that make? If Trump got his wishes, what would that do to the economy? Why does he want that?
Well, I think if you cut to 1%, unless you think the labour market's really, really weak at the moment, because of the uncertainty mainly created by Trump, it has to be said, unless you think it's so weak that you need to go down to 1% to get job growth back, then what a 1% would probably do, going down that low, would probably fuel inflation, right? It could set off a wage price spiral. And the fact that in that situation, if Trump was pushing for that and the Fed just accommodated it, the feeling, I think, amongst commentators and amongst business more generally and the financial markets would be that the Fed's independence had been fatally compromised. And that might lead to further economic problems, because the Fed would be seen by the markets as basically an appendage of the White House, the presidency, right? Which is exactly what you kind of don't want to happen from an economic point of view. So I think there could be huge problems on that front if you went down that low, and it was seen to be being driven by Trump's own kind of wishes.
But can we take that a step further? Because that was going to be my next question. Look, politically, I understand the Fed obviously is apolitical, independent of party politics, Democrats, Republicans, it doesn't matter who's in the White House. The Fed does its own thing. And Donald Trump, we understand, is pushing the boundaries of executive power by putting as much pressure as he's putting on the Fed to do what he wants, which is an aggressive rate and interest cuts. Let's leave aside the politics of that for a moment. If you're an American consumer from the point of view of just the U.S. economy, what is the problem with that and why does it matter?
Well, the reason it matters is because it looks like Trump just kind of trampling over institutions in the US economy just to get what he wants in the short run, without any regard to the long-term consequences of what it looks like to businesses and financial markets if the Fed is seen to be operating just as I say, just as an appendage of the White House. So that would basically, if that were to happen and that were to be sustained, then I think businesses and markets would basically come to the conclusion that Fed independence was no longer operative, and that we just had basically the Fed doing what Trump kind of wanted it to do.
Howard Reed, thank you very much for joining us on the program. You're the founder of Landman Economics. Thank you.
Thanks very much. Nice to be here. Thanks.
China is conquering the world of electric vehicles. Its automakers produce more electric cars than any other country and outpace them on innovation. At this year's auto show in Germany's Munich, Europe's largest motor show, Chinese brands have challenged European ones right in their own backyard. They have unveiled flashy new models with advanced tech and lower prices than their Western rivals. China's car makers made it clear that they want to expand into European markets even further. Yet Beijing's boom abroad contrasts with troubles at home, where an oversupplied market has triggered a bruising price war. Dominic Kane reports from Munich.
It's one of the world's largest motor shows, drawing in hundreds of thousands of visitors, lured by the prospect of a glimpse at futuristic electric vehicles, but also at the more realistic options the major manufacturers are offering. And at this year's show, Chinese cars are hard to miss. 30 years ago, car maker BYD did not even exist, but now its vehicles are on show like never before. And its message seems clear.
Our clear goals are to be perceived as a European brand, we now also manufacture in Europe, combined with a very broad product portfolio. We now have 11 vehicles in the lineup, and we're very proud of that. We really cover 90% of the product segments in the German car market.
These are some of their latest offerings, a mixture of hybrid vehicles and fully electric ones. Using flash charging, BYD says EV drivers will be able to go from next to nothing to around 200 kilometers range in just a few minutes. But some of their European competitors are skeptical.
Volkswagen still leads in terms of new car sales in Europe, despite the perception that some of its existing EVs have been unpopular. For this firm, it seems the automotive offerings on show here are the way ahead.
New competition coming in, so we will readjust to this, and now with the electric vehicles we're bringing in, plus another 7 new electric vehicles by 27, we have a fantastic lineup that can compete with any of these newcomers. That the Chinese competition will come to Europe was always clear, and we will face it.
But how does a brand that calls itself the people's car bring back those who've lost interest?
What they've realised is that actually customers don't really want to buy futuristic electric cars that they don't know. They actually like the familiar stuff. So I think brands like Polo really resonates with people in terms of it's a nice small car. And that means that, in the future we're going to get an ID Golf, an electric Golf, and a Tiguan, and all the Volkswagens that you sort of know are going to come back in electric form.
There's no doubt that electricity is driving the mindset of the main manufacturers right now. It's a view the German Chancellor shares.
We want to shape the transformation of the automotive industry rather than lag behind it. And we want to exploit the great opportunities that this transformation offers for the German automotive industry and for Germany as a whole.
But some analysts say such words disguise a troubling trend, that Germany has failed fully to appreciate the transformation from combustion engines to electricity, and more particularly to autonomous driving.
If the German car industry continues like this, it will lose its markets. It has already lost more than a third of its volume in China. It will also lose in Europe and across the world. I can imagine that 10 years from now, the German car industry will only be a third as big as it is today.
Which could have a dire effect on the German economy, given the continuing importance of its automotive industry. Whereas Chinese manufacturers have no such worries. They are clearly focused on an electric and eventually autonomous future. Dominic Kane for Counting the Cost in Munich.
And after that, we've got some questions for Lei Xing, co-host of China EVs and More, also a former chief editor of China Auto Review, and he is joining us from Beijing today. Thank you very much for being in the show with us. So we saw Dominic's report, and one thing that strikes me is that 10 years ago, nobody outside of China was buying Chinese cars. And now, as our reporter Dominic Kane just showed us, they are doing very well, and they are actually eating into market share of European car makers in Europe. I mean, that's an impressive achievement. How did Chinese electric vehicles get to this point?
Well, it's a combination of price, performance ratio, feature, tech, and probably the biggest advantage or maybe the trick is Chinese are moving fast. In terms of tech innovation, development, new features. Really, the China speed is what everyone talks about these days, and that's the underlying reason. That they move fast and they compete. So I think that's the bottom line.
The Chinese electric vehicles, when it comes to the European market, had a price advantage. They were cheaper. Now, the Europeans have responded to that. They feel that there's unfair competition going on. They feel that China has subsidized its electric vehicle makers, that that's unfair. And as a result of that, the European Union has imposed steep tariffs on Chinese electric vehicles, up to about 35% on top of the 10% that already existed. So that's very steep. Has that completely erased the price advantage that Chinese cars had on the European market?
No. I mean, to be honest, yes, the same Chinese EVs that are selling in Europe, for example, the recent BYD launch of their new car, is much more expensive than they are selling in China. But again, it goes back to when you have the right products, that features the latest tech innovation. And also, I think what the Chinese have been doing is working with the right local channel dealer partners in Europe, which really has helped them. And the tariffs so far, I think the discussions are still being had, but it really hasn't affected, let's say, put a complete wall against the Chinese EVs. I think they're still selling quite significantly, although volumes are not as high as the homegrown brands, but they're slowly moving up as we can see from the market share.
What about the other way around, European car sales in China? Because I'm old enough to remember that 20 years ago, that was the story, right? For your Volkswagen, your Peugeot, et cetera. Growth for them, sales growth in Europe was sluggish, but they went to China, a huge market, and they could sell many cars there. And that was their main avenue for growth. Look, I was in China recently. I did not see Volkswagens. I did not see Peugeots. I saw many Chinese brands.
Well, that might be a little bit exaggerated. Just put this into perspective. Volkswagen brand is probably going to sell somewhere around 2 million units. And at its height, that number was close to 4 million units. So there's a perspective, but 2 million units is still a lot for a brand in China. And we're seeing some of the Chinese brands that are catching up, and perhaps they will move up to the 1 million unit a year mark. So we're seeing this gap continue to close. But again, these foreign brands, as what they've shown at the Munich Motor Show and the Shanghai Auto Show earlier this year, is they're expecting next year to be what they think is a year of delivery, kind of a comeback. I think Munich showed some confidence of that, of their next generation products. So I think it's still to be decided.
A co-host of China EVs and More, Lei Xing, thank you very much for joining us on the program today.
Thank you for having me.
Senegal is battling a mounting debt crisis. It all unfolded last year after a review of the nation's finances uncovered $7 billion in hidden borrowing by the previous government. That is more than 1/5 of the country's GDP. This led the International Monetary Fund to freeze almost $2 billion in loans, while rating agencies downgraded the country's credit further into junk. The new government says that it must now raise taxes and cut public spending in order to address the shortfall. But critics warn that austerity could backfire, slowing growth, sapping the very tax revenue that it seeks to raise. Nicholas Hack reports from Dakar.
Adama loved to play football, a game he will never be able to play again. Having to use a wheelchair, his only caregiver is his dying mother. Jazeera has cancer. Treatment is out of reach, and so time is slipping away fast. Perhaps in a year, her 6 children will be left alone, with a fridge bare of food, filled with their belongings. Gone is the $40 welfare grant she received every 3 months from the government. And so she survives on loans, debts her children will one day inherit.
I feel blessed because despite everything, he is alive, and I can spend my time with him. But the disability is hard on us. Everything we have goes to his care.
500,000 families in Senegal have lost the welfare payments that kept them alive. The government cut the program after the IMF froze vital funding. Auditors later uncovered $7 billion in hidden debt concealed by the previous administration. Now the IMF demands austerity before releasing new money, a move critics say holds struggling Senegalese hostage.
When President Macky Sall and his government contracted this debt, the IMF said that the debt was sustainable. The IMF said that this debt was productive. The IMF said that this was a good debt. Today, we discovered that this debt was neither sustainable nor productive, but worse, we have uncovered hidden debt. And so the question is, where was the IMF? Did the IMF lie to us? Did the IMF prioritize the interests of Senegal's creditors over the interests of Senegalese citizens?
Politicians promised oil and gas would bring prosperity, fueling hope for many. Instead, Senegal's debt has grown drastically, becoming one of Africa's most indebted nations. Look at Dakar's skyline, rising but half-built. It tells the story of Senegal's debt, borrowed money fueling construction, leaving soaring bills behind. Most of it is owed to local banks, not foreign lenders. Now families have to pay the price. The new prime minister is raising taxes, halting projects, and imposing visa fees.
You get the impression that there's a desire to suffocate the country, but the country is still holding together. A lot of people say to us, but how are you coping with this situation? The country is still holding together. And my wish is that we will be able to get out of this situation through the efforts we will have made with this recovery plan.
But activists say canceling the debt, not imposing austerity, that will end what seems like an endless cycle of poverty, passed from one generation to another. Nicholas Hawk, Al Jazeera Dakar for Counting the Cost.
So what does Senegal do next? That's what we're asking Gospel Obele, an African economist for Streetnomics, a Nigerian think tank. And Gospel, you're joining us from London. So from one day to another, Senegal just suddenly realizes it has a lot more debt than it thought. Is there a playbook for how to handle something like that?
Well, to start with, thank you very much, Cyril, for having me today. It's a culture that is significantly hidden when it comes to how public finances work and governance to a large extent, particularly in developing economies. The thing around government leakages, fiscal leakages, and poor responsibility when it comes to managing public finance and the like. So we've seen that that culture has led to significant debt challenges, in Africa. So it's significantly the culture around things. And until that cultural landscape or the behavior around how public finance officials or government think about debt or debt monies or debt financing in the first case, we might not really be able to, make some form of significant progress when it comes to situations like this.
The Senegalese government is currently saying what all governments that are faced with a huge amount of debt say. They say, well, we're going to have to spend less money. That means cut public spending. And we're going to have to raise revenue. That means increase taxes. There's a word for all that. It's austerity. And our reporter, Nicholas Hack, showed us the effect of austerity. It means that ordinary Senegalese people who depend on government help and government spending, some of them won't be getting it in the future. Is austerity the answer?
I don't think austerity is completely the answer. It might sound like a necessary condition to have now, but again, it's not sufficient. And if you look at things from a more sufficient context, these are the critical lines that impact on the socioeconomic well-being of individuals in a particular state. You talk about poverty. Poverty levels are high, over 50%. Over half of the population in Senegal currently live below the poverty line. You've got youth unemployment significantly high, over 19 to 20%, amongst those between ages 15 to 24. So that's significant local socioeconomic challenges and issues, as the case may be. And then again, it speaks to the fact that we aren't discussing or talking about the major thing in the room, the elephant in the room, which talks about the leakages in society, the weakness of MDAs or ministry departments and associations, or how generally the culture around public finance, how it works, not just in Senegal, but in Africa. Now beginning to think of how we can use austerity measures to win over the debt argument is technically presenting itself as a trade-off on socioeconomic lines. So I do not believe that that is the most sustainable route to go. I think the institutions need to begin to look at themselves in the mirror, to begin to ask the critical questions around what are the leakages to start with, what are the low-hanging fruit that we probably need to close, what gaps needs to be closed to find ourselves back again in terms of prospect for debt sustainability, prospect for debt restructuring.
Well, Gospel, you mentioned that there are some low-hanging fruit. Here's the one I had in mind. Senegal just became, late last year and earlier this year, an oil and gas producer. It is now selling oil and gas, which wasn't the case before. Could that be the get-out-of-jail-free card that fixes Senegal's finances if that oil and gas revenue comes in?
Well, very interesting. It could be a potential get-out-of-jail-free card. That's if Senegal chooses to work around its oil and gas sector in such a way that it's much more competitively viable in the international market. And what that means, for instance, if you look at the case of Nigeria, we've got crude oil, but we don't have vibrant refineries. So we're technically selling the raw materials, and that's also, the raw crude, and that's impacting on imported inflation because we then have to import the finished product. So if Senegal takes cue from economies like Nigeria, it will then begin to think of how to ensure that its oil, its crude, as the case may be, is being revamped and value processed in such a way that it can gain much more value from that, value chain of some sort. Until that is done significantly, and also looking at the non-oil sector, the low-hanging fruit around the MSME sectors, those who are producing, ready to export and all that, how are you mobilizing that segment in the economy, or those economic agents, to be much more competitive, not just in the global landscape, but also in the regional landscape?
Gospel Obele of Streetnomics, thank you very much for joining us on the program.
Thank you for having me, Cyril.
And that is our show for this week. Do get in touch with us on X. I'm at Vanier Cyril. Use the hashtag AJCTC when you do, or drop us an email, countingthecost@aljazeera.net. That's our address. And there's more for you online at aljazeera.com/CTC. That will take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Cyril Vanier from the whole team here in Doha. Thank you for joining us. The news is next on Al Jazeera.